Today, we are going to unpack a pretty huge shift in how we figure out what a company is actually worth. We're going to explore why the old financial rulebook, the one that worked for decades, started to feel a little outdated, and what new tools investors are using now to see the whole picture. All right, let's get into it.
So, it all boils down to this one simple but incredibly complex question. For the longest time, the answer was right there in the financial statements. The balance sheet, the income statement, all of it. But as you're about to see, that has become a smaller and smaller piece of a much bigger puzzle.
To really understand where we are now, we have to go back and look at the original rulebook. This was the language that everyone in business agreed to speak when they were talking about value.
I just love this quote because it frames accounting perfectly. It really is a language. And for most of the 20th century, that language was built to describe an industrial world. A world of factories, machinery, and physical stuff you could count in a warehouse.
Now, the grammar and the vocabulary of this language, that's what we call GAAP, or Generally Accepted Accounting Principles. And the whole point was just to get everybody on the same page. It was to make sure that $1 of profit at company A was comparable to $1 of profit at company B. It was all about consistency, reliability.
But here's the thing. What happens when the official language just doesn't have the right words to describe new realities? Well, people start making up their own. And that is exactly what companies started to do.
Pretty soon, companies began to feel that the strict rules of GAAP just weren't cutting it. They weren't fully capturing how well they were actually doing, especially during big one-off events like a merger or a huge restructuring. They were worried investors were missing the real story.
And this led to the rise of what we now call non-GAAP measures. The best way to think of these is like extra commentary or footnotes. They're financial numbers that aren't officially part of the GAAP rulebook, but companies use them to give what they feel is a clearer, more adjusted view of their business.
And oh boy, did this become popular. A classic example is EBITDA. That's earnings before interest, taxes, depreciation, and amortization. Now, that's not a GAAP metric, but investors love it. Why? Because by stripping out all the accounting and financing decisions, it's seen as a much cleaner look at a company's core cash flow. It was really one of the first big signals that the standard rulebook just wasn't enough anymore.
But the rise of these non-GAAP metrics, that was really just a symptom of a much, much bigger change happening just beneath the surface, a truly seismic shift in what actually creates value for a modern company.
You see, the old language of accounting was fantastic at measuring tangible assets, the physical stuff, right? Factories, inventory. But it really struggled to put a number on intangible assets. I'm talking about things like brand reputation, intellectual property, customer relationships, all the assets that are the real engines of the modern economy.
Okay, this chart right here, this shows the single most important economic shift of the last 50 years. Just look at this. Back in 1975, over 80% of a top company's value was in physical things you could literally touch. Fast forward to 2020, and it is completely flipped. 90% of market value is now tied up in these untouchable, intangible assets. It's staggering.
So what does this all mean? Well, the gap between a company's book value, what the financial report said it was worth, and its actual market value in the stock market grew into this enormous chasm. The official language of business was simply failing to describe what was actually valuable.
And listen, this wasn't just some academic debate. The people who actually set the rules for the financial markets, they realized they had a massive problem on their hands. The reports were becoming less relevant, and they knew they had to do something about it.
So, how did they respond? Well, starting back in the 90s, major organizations like the AICPA and the CFA Institute, they officially acknowledged this gap. They started calling for companies to provide more forward-looking information. So not just what happened last quarter, but what management's plans were, the risks they saw coming, the opportunities they were going after.
This led directly to things like the Management's Discussion and Analysis section, or the MDA. This is now a required part of a company's filings. It's basically where the leadership team has to provide a narrative, the story behind the numbers. They explain the trends, the uncertainties, their strategies. It was a formal expansion of financial reporting that went way beyond just the spreadsheets.
But you know what? Even the MD&A couldn't capture everything. To truly get a handle on these new value drivers, investors had to start looking for entirely new kinds of information and totally new ways to analyze it. And we can see this evolution so clearly in the rise of what's called responsible investing. I mean, it started decades ago with simple negative screening, basically just avoiding certain industries. But it grew into something much more sophisticated. Today, it's all about ESG integration.
That's systematically using data on a company's environmental, social, and governance performance to spot real financial risks and opportunities.
And this right here is the key. It's not just about values anymore, it is about financial value. This chart, I know it looks a little complex, but it shows you exactly how this works. For example, take a look at that revenue column. A sustainability issue like, say, counterfeit drugs for a pharmaceutical company, that's not just a social problem, it directly threatens that company's long-term revenue. Or look at the cost column, an environmental issue for a logistics company, that's going to have a direct impact on its future costs. Investors are now using this kind of ESG data to make real concrete predictions about everything from revenue and costs to a company's borrowing expenses. So if you take away just one thing from this entire explainer, let it be this. Traditional financial reports are still absolutely essential. They're like a high-quality look in the rearview mirror. But this new world of intangible value and ESG data, well, that's the map that helps investors try to see the road ahead.
From GAAP to non-GAAP, from tangible assets to intangible capital, this language of business is constantly changing to keep up with how value gets created. And that leaves us with a pretty fascinating question to think about. As the world keeps changing, what's going to be the next critical piece of information, the next word that we all need to learn to truly understand what a company is worth?